Well, here we are at the final panel, and Tony is going to take over the moderation, and this should be a fun one. I will say, although 12:30 is the time, if the conversation's going well, we're going to just have some, just like Bill Maher's overdrive, so we'll just keep it going. But let Tony go ahead, and when it fizzles, I'll come up and get you.
Just wave me off. Wave me off, or hook. Again, good afternoon, everybody. We've got our final panel of the day, and a great group. So we'll have a lively discussion and do break in freely. And just to preface, we've been dealing with a pandemic the last 18 months, and I think there was a big halt, and then people realized, well, this ain't going away, so we got to keep going, and they found ways to keep going. And it changed how you went forward. So that's what this panel is here to talk about. I hope I got the topic right. And so I'm going to start with our far right here. And
okay,
give us
great.
Your thoughts on, you're in the bankruptcy service industry.
Yes.
And you tell us.
Yeah, no, thanks, Tony. Good to be here. I'm Jonathan Carson, CEO of Stretto. 25 or so years in the bankruptcy space. I'm a recovering lawyer also. Began my career at a very large firm in Chicago. Ultimately left to found a technology company in the Chapter 11 space with my partner, Eric. We kind of grew it, sold it to a public company, ran it, and then got back in the space about 4 years ago through acquiring a different bankruptcy tech business, this time with outside private equity capital. And in the last 4 years have now grown ourselves into about 5 different businesses. We operate in various parts of the bankruptcy system, from the corporate restructuring, large cap claims agent world into the consumer bankruptcy world by the trustees, as well as the largest SaaS business. And maybe on the operating side, the last couple of years have been really interesting, not just in terms of watching bankruptcy filing trends, but we've also done 2 acquisitions in the pandemic time, and kind of interesting to see how that's panned out. Some good, some bad, some yet to be seen, right? But very interesting couple of years, not traditional in terms of running a growth business, but fun.
You know, Scott, you're an investor, operator, and an executive of a number of companies, and you're looking at acquisitions and probably even maybe a disposition if the price is right. How has the pandemic sort of affected your operations and transaction focus?
Right. My name's Scott Sinclair, president of Sinclair Range, and I think for context, you should know that I work in middle market and a little bit smaller, largely or entirely on distressed assets. So we work with troubled companies. And another piece of context is that for 30 years, I've been on the turnaround advisory and the investment banking sell side predominantly. So I do know deals, right? And then we transitioned our firm coincidentally right before COVID into a buy side investing firm. And so we've completed, I think, 3 transactions during COVID, 3 acquisitions. So we own I own 100% of Sinclair Range. We own 100% of a company that produces and sells tools to the roofing industry. In June 2020, I bought a stainless steel sink manufacturer. And October 1st just passed, we bought a tier 1, tier 2 automotive supplier on the sealing side of things. I own and run a commodity extraction facility that I won't mention the commodity, so you don't get your web cache shadow banned for distribution, financial services. So a number of different industries, and largely all deal focused. And I think COVID has really brought a number of challenges. In the early days of COVID, to me, it was really just a nightmare on what I would think of as deal infrastructure. Right, if you're buying a distressed company and you need an ABL, you need auditors, you need appraisers, you need corporate lawyers, solvency lawyers, M&A lending lawyers. You need a field audit, and how do you just logistically in different jurisdictions? Because a lot of what I do is international. I think we've been in 27 countries in the last 4 or 5 years. How do you just organize that when people can't travel and they can't be on site? How do you get staff there? Because that's the operating side of it, post-deal. So that's been an issue, which is clearly sorted itself out a lot, but not in every jurisdiction. And we sit down here in Miami and everything's great and free, but not everywhere. not everywhere. It's still a problem, and it could go back. So I think of the infrastructure. I think of valuation. You know, how do you have a company that's knocking it out of the park during COVID? Is that a maintainable EBITDA? Is that a sustainable, transferable number? Or the opposite? How do you, if you've got a company that's been crushed, is that going to be that way forever, right? And is someone going to sell? And so valuation. And the third thing that was on my list, somebody talked earlier on another panel about the psychology of transactions, which is my sweet spot. I love that, notwithstanding that I'm an accountant. And positivity. Like how do you can't quantify, you can't even conceive of some of the risks. I bought 2 companies during COVID that have been shut down because there was no steel and no rubber, respectively. Right? We were shut down for 5 weeks in August. Well, I couldn't quantify that. I didn't foresee that coming. Right? So there's just different risks that you don't even know about that have changed.
But it creates opportunities too, it seems.
I think it creates huge opportunities because there's lots of prospective buyers on certain platforms that they just won't deal with that. And so if you're in the distress space, maybe you're one of a few players.
Robert, Riveron, tell us in your words, but you're a service provider to transaction-focused folks, PE and other buyers. And so give us what your perspective is.
Right, yeah. So I'm with Riveron. We were acquired by HIG in late 2019, so an interesting timing from their perspective. I'm actually on the restructuring and turnaround side, former legacy Conway McKenzie. But the implications of COVID have been profound just on our business alone, as you mentioned. The fact that I'm here actually suggests how frothy the deal market is, because my transaction guys couldn't make it because they're busy closing deals before the end of the year. And from our business perspective, the restructuring guys were carrying the business in 2020. And I'd say the pendulum swung the other way now. Our financial advisory services guys, the transaction guys, are growing faster than we are, frankly, right now. I think we heard on the last panel some potential warning signs in the future about the restructuring market getting frothy again.
Music to your ears?
Yeah, absolutely. The timing of the acquisition of our company, I think, was strategic. Everyone, I think, foresaw a turn down in the economy with burgeoning consumer debt and corporate debt. No one obviously predicted COVID, but we on the distress side, some of the deals we're working on, we're seeing exit financing arranged at 2019 multiples, at 2-3 years forward-looking earnings. To your point about what is kind of the right sweet spot for picking an earnings upon which to apply a multiple. So it's we call them Chapter 22s in our business, chapter companies that emerge and then go back into bankruptcy. I think we're going to see an interesting dynamic around that in the next 12, 24 months.
Bruce is the lender on the panel. Lenders are looking at things differently, but let's go back to when the pandemic started and PPP was pushed out there, and that kept you folks super busy.
Sure, absolutely. Bruce Dembe from CIBC. I run their asset-based lending group. It was really interesting because when this all broke, there was a lot of concerns about where things were headed. PPP was launched extremely quickly and gave a lot of clients that sort of footing that they needed through those first 2 months, 3 months of the pandemic, where they were really trying to figure out, which end was up and what was going to happen, when really nobody knew for sure, right? So the reality is that helped launch, give them liquidity to get into sort of the next phase, which is overall, and Hugh mentioned it when he was up here. The reality is that there was a lot of folks in the turnaround industry that were surmising towards the end of 20 and early 21 that the lenders were hiding all the bad deals. That they're there. They're just the OCC gave them a little bit more rope, and they're using it, and they've got them stashed away in their pocket. And the reality is the portfolio stayed pretty clean. But the problem is with PPP and ERC, which ERC has been, the numbers are staggering, truthfully, that we've seen some of our clients get with ERC, employee retention credit, that it's driven down loan volumes quite a bit. And as the lender panel just before us indicated, the frothiness that's out there. But when you look at the statistics in the ABL world, The reality is that loans fell 20 to 25%. We've got a group of about 25 of the larger lenders that report in on a quarterly basis. And so we dropped into numbers that we hadn't seen since early 2016. And even with the latest quarter that just came out, the third quarter, we're still at 2017, mid 2017 levels in loans. So what does that mean? That means all the lenders have to figure out a new way to fill the bucket up, right? And suddenly that 85% receivable is now worth 90%. And that 85% of NOLV inventory is now worth 95 cents on the dollar. You know, somehow assets appreciated during COVID. I'm not sure how that worked, but somehow it happened. So the frothiness is there, and it's cause and effect. Everybody's trying to fill up the bucket. But as Scott mentioned, the interesting thing in our business was the different things that we had to do to approach the business. I mean, I closed my first deal in 30 some years where I hadn't met the management team and the owners face to face and shook their hands and looked them in the eyes. I mean, it was just kind of weird, right? I mean, you just never would have thought that would happen. We did our field exams differently. You know, we didn't do test counts. In some cases, still not doing them in some places. So there's things that have sort of been compromised a little bit that will come back to bite you eventually unless we start to get back to somewhat of a norm. But certainly a lot of changes.
Yeah. Scott, you mentioned a little bit about supply chain issues, but talk about the labor issues, because you've got operating companies, you need hands to do the work, and how are you getting them, or how are you struggling through?
I think the supply chain issue is labor issues. Okay. Well, I know that for a fact within my supply chain. I'm sure there's other competing global forces of which I'm unaware, but everybody that I can't buy a commodity from, it's labor shortages at their end. The manufacturer that I took over October 1st, I bought it out of a Canadian receivership. And unusually, the receiver was actually operating the business while they were running the CISP, sales and investment solicitation process. And they were operating at about 45% of the normal labor force. And so we've gotten back up to, say, 90% in that range in the first 60 days. But we changed it up a little bit. I stopped using recruiters. I hired a local marketing agency within that community, and we just blasted Facebook. If you woke up in the morning and you wanted a job, you knew the name of this new company. And then we were paying hiring bonuses, retention bonuses, this bonus, that bonus. And so what have I done? I've just hugely increased my direct labor costs. That's what I've done. But we won, and you can't afford not to. So,
Jonathan, you mentioned the other day when we were kind of having our pre-call that while business bankruptcies are down, personal bankruptcies are up.
No, also massively down. So we're seeing similar issues. I mean, we experienced in our corporate restructuring, which is a larger cap business. 2020 came in the business massively upticked in terms of volume. Everything seemed to come through the funnel at once. It was really busy for 9 to 12 months, and then 2021 came and it really kind of fell quite a bit. And that's not surprising given what came through the funnel last year. On the consumer bankruptcy side, which probably a few people in here pay attention to, I mean, filings are 45%-ish of what they are historically over norms. 20-year average of 1 million bankruptcy filings a year. We might see 420,000 this year if we're lucky. Government programs really kind of shielded the consumer, and there's no real reason for lots of people to have to file bankruptcy, and with interest rates at record lows, that probably remains until these programs come to an end, and then we'll see that shift back up in the direction. But I really agree on the labor and the supply chain problems causing issues. Fortunately, on the operating side, it's fortunate to have had a labor force that's kind of resilient and remote and willing to work in different ways. We've found people have been really productive, happy, and efficient from home, largely speaking. But from the business angle of what you see in the market, the supply chain and labor issues are really difficult to deal with, and I imagine will cause a lot more work in our space in the coming year or two.
Okay. Robert, and maybe you're in the restructuring arena, but from a Riveron standpoint, as they're doing transaction advisory, I mean, have they changed their checklist of things to really look into, or is that? Asking beyond.
Yeah, I can speak a little bit to that.
Yeah.
Certainly, I think the accounting for and government stimulus money and the ability to create more discretionary funding from there, I think is one of the new checklist items. I can't think of another particular issue that's really changed. To your point, other than it being remote, I mean, I think the underlying drivers are what they are. I mean, I think there's a lot more work done to understand normalcy or new normalcy, depending on the business, and therefore what the buy side client should be looking at in terms of underwriting earnings. But I don't think there's any particular new hot buttons that COVID is.
And Bruce, as a ABL lender, you have a checklist too. When you're going through the underwriting, is this a credit we want to pursue? What have you seen change in your checklist,
Sure.
so to speak?
Well, and I think it was alluded to in a couple of the panels is sort of what's the COVID impact of these businesses, right? I mean, it really is very difficult to read. We had several clients that got a COVID bump because of either they're in the food business or they supply items that picked up during COVID, and we know that's going to cycle back down now. Some of those guys have gone ahead and sold because the market doesn't seem to think that it's going to cycle down based on the valuations they're giving them, which is great for them. On some that have been adversely affected, and the supply chain now is sort of taken over in my mind from COVID, and as far as affecting some of these businesses, it's a question of when will things come back. The good news is that a lot of these clients went into this period of time where they're starting to see the ability to grow if they can get the product in with a lot of liquidity. And so, we kind of look at that sort of ability to make it through and have that liquidity to get through that next bump, whatever that might be. And we see a lot of clients that have pretty good liquidity going into this cycle, even though growth has its own way of causing a lot of problems. That a lot of times lead to a lot more business for the turnaround community. So,
Robert's happy to hear that. So.
Exactly. Yeah, I know. We just did a deal. Actually, Stretto's on the case, but we just refinanced an ABL lender in preparation for a pre-pack. Went out to a very kind of tight community, and they have negative free cash flow forecasts for the next 9 months probably. And to our surprise, we got 6 term sheets from the folks, including regulated banks who we thought wouldn't even touch the deal, and we got better terms and an upsides facility.
And they're trying to just build their portfolio with that.
Yeah. And but as someone else said, it's very incestuous, right? A couple of the other funds that we talked to, their leverage was provided by the regulated institutions who are also competing on our deals. So looking for creative ways to put
Can I ask a question, Tony?
Yeah, go ahead.
So Bob, can you talk for a minute about on the service side? A lot of people, we've only heard from a handful of lawyer types, and on the advisory side, what's it been like working with businesses that typically you're with every single day, your teams of people? We do it as well, but ours is more technology oriented and less kind of client service day-to-day driven. How has it been working with teams in that way for the last year plus on the service side?
Very bizarre.
Yeah.
We're advisors to the Unsecured Creditors Committee of LATAM Airlines. We met our clients, the lawyers who brought us in Deckert, for the first time last spring. Never met anyone on the management team. Never met anyone on the financial advisory team or the investment banks. And we're, locked in pretty heavy negotiations and discussions. So it's been bizarre, but it's amazing how quickly people transition, right? I mean, at the beginning, it was some trial and error on technology and form and whether you need video or not, and now guys are eating sandwiches while we're talking, and judges have transitioned everything to Zoom and have a strong preference going forward for doing everything virtual. So it was, I won't say it was seamless, but it was pretty miraculous how quickly things
And it's
changed.
crazy. I mean, it's different on the lending side. I'm not a lender. I've never been a lender. I'm sure it's not easy not to look someone in the face when you sign documents. But on the day-to-day advisory side, again, we've all done it. We've morphed into that place. I've got a summit today for 4 hours on Zoom with 40 people. We just do it now, right? But I imagine it's been strange serving clients like that, like people you haven't met before day-to-day in the advisory capacity.
Absolutely.
Have you found it more difficult, though, to have a sort of a heart-to-heart where there's a contentious issue? You'd just be way more effective in the room with that person. I'm convinced. I worked for a year on a restructuring that fell apart at the end of the day with a second secured creditor. And I'm convinced if I just could have been there in front of that lender and walked through it, that just the connection on, what I found is on Zoom, they were just very agreeable. But they didn't mean it.
They could run away. Yeah.
Yeah, absolutely. And I, like you, focus a good bit of my time on Latin America, and it's very much kind of upfront and personal and touchy-feely. So it is, excuse me, it is more challenging. But invariably, when we know there's a meaty subject on the agenda, everyone is on video, so at least you can look them in the virtual eye and try and read body language. So, yeah.
Now, one of my final questions, and all of you, some of these changes probably be permanent. The virtual technology that we're all using, it's helping, certainly, keep things moving, but it's not optimal. And what I really want to focus on is what are these changes that the pandemic has brought are permanent, and what's gonna fade away as being temporary because it's really not optimal way of doing business. Bruce, you want to take a first shot?
Yeah, I've thought a lot about that one, and it's still tough to read. I think. I mean, I sit there and think about our workplace, for instance. I mean, the remote environment worked extremely well in the banking industry in general, and especially in our shop, a lot better than I would have ever expected. So much so that it's a little hard to draw people back as we start to think about getting back together as teams, and sort of that camaraderie of a team and everything like that suddenly gets lost a little bit. You've got younger folks that really could use the tutelage of some of the more senior members of the team, and the ability to kind of walk across the transom, 2 feet and talk to them is a lot easier than picking up the phone or jumping on a Teams call. So we need that connectivity. I don't think we'll go back to 5 days a week. I don't think that's going to happen. But certainly there's going to be more connectivity. As far as the diligence side of things, I think that's going to morph back to what it was. I mean, we need it. The reality is it wasn't something that we were just doing because the guy before us did it. It caught problems and issues and things that had occurred. And so that's going to get back to where it was. Now, is some of that going to be remote? Possibly. Your field exams might not be all on site like they used to be, and you might lose some things doing that. But, so I think some of that will move back. But
yeah, and I got to believe, going back to the supply chain issue, I mean, I'm originally from Canada. It sounds like you are as well from your accent. The supply chain...
And I'm owned by a Canadian.
There you go.
It's a Canadian panel.
It sounds like an imminently or a quintessential Canadian problem. Well, I can't get my car for 6 months, so I'll just wait. I mean, I got to figure there's American ingenuity at work now trying to solve those bottlenecks. Granted, you can't build ports and bridges and roadways overnight.
Chip plants in a
right.
day.
But I don't believe it's a new normal that we're going to get used to paying $10,000 over list price for a new car, right? So, I mean, I think and it's kind of an interesting paradox right now, right? Because you've got inflation and yet you've got all this pent up demand, right? So I think once that gets unlocked, it is going to, I think, produce a nice shot in the arm.
A crisis or?
Well, I mean, there are industries, with structural challenges. I think the travel, hospitality, and leisure is having to reinvent itself. But I think for consumer goods and durables, I think there is people didn't have anything to spend their money on for 18 months, right? So,
okay, Scott, you know,
I don't think there's anything that's going to be sustainably changed coming out of this pandemic. I think the things that I highlighted, the valuations, the due diligence, and the infrastructure for transaction, they're all just going to come back. It's just a matter of sort of the continuum that they're on. And I even think the virtual workplace, that was a trend that was accelerated by COVID, but it was happening anyways. The professional side of my firm has always been virtual. We didn't require you to come to an office on a day-to-day basis. And now what's happened? The technology's got better. But I would remind you, you're all professionals here. There's a whole world out there that are not professionals. Right? All of my manufacturing companies, people show up there every day, and they have throughout the entire pandemic. And that's not going to change. And we we hire people in the front office and the management, and they ask if they could have a virtual, during the interview, what's our virtual policy? And the answer is there isn't one, right? You're part of management. You've got a bunch of direct labor in the back. They show up every day. You need to be there too. And so I think there's changes around the fringe, if I can put it that way, for professionals specifically, people that go down to the core of whatever city that they're in. But that was already happening.
Mm-hmm. Okay. Jonathan, you got?
I asked the question a lot. When pandemic began, I started walking 5 to 10 miles every day. I'm 19 months in and it hasn't changed, and that's great. In terms of what I think might change or not, I would make 3 comments. Number 1, on the employee side, at least for us, technology, services, hybrid business, 350 employees domestically. I'm bullish on the remote work dynamic. We're productive, we're efficient, and we're effective, at least operationally, and I think that probably remains in large part. Although I think that's probably short-term, day-to-day focused, and there's definitely issues about working on the business and the mentor dynamics that you can't accomplish virtually, and we're dealing with those now. I think, and Aaron mentioned we've known each other for a long time, and I've been in YPO for 15 plus years. I have a lot of friends in that world that are struggling to get people to come back to work. We've kind of embraced it, and it's so far going okay. I think on the M&A side, as was mentioned, we did an acquisition 1.5 years ago. It was a good deal. It was valuable to us. It'll prove long-term value to the business. It was a pain in the ass, and we could have done a better job had we been in person to do a few of the meetings and got some stuff done. That, I think, will change. And I think lastly, again, we haven't talked about it that much, but I mean, interest rates, man. It's been up and down as a roller coaster. And whatever you read these days, is there 2, is there 3 increase? It has to normalize at some point. And when that normalization happens, whether it's 24, 36 months out, I feel like we'll be allowed to see our environments progress naturally or organically and see defaults come and go, restructurings come and go. But until then, it'll be, I think, uncertain and volatile.
Well, I didn't open it to the audience here. Has anybody got a question you want to ask the panel about the pandemic issues we've all faced?
Or who wants to get to the beach?
Who wants to?
So the question is regarding the technology with deals. Did the technology make the deals, make more M&A happen more efficiently, more effectively? Did it increase the number of deals that were being done? Zoom.
I don't know.
Yeah, I'm not sure who that's directed at. I mean, the answer is yes. I don't think I have empirical data at my fingertips, but I think the absolute answer is absolutely yes. I mean, you see, not only in terms of the flow of information, but even on the diligence side, right? You see a lot of outsourcing on bigger deals. You see a lot of outsourcing of a lot of the kind of the data room grinding offshore, for example. And I think that's a phenomenon that's going to continue. And I think that's made deals more efficient, and then by nature, then more get done as long as there's.
I think it's absolutely yes. Is it a good thing? I don't think we know that yet. More is happening, more can get pushed through the funnel. It's easier to do things back and forth, but again, in the end, is that good? I don't know the answer to that.
Thanks, guys. Really nice job. Scott, I sort of have a question for you. You talked about, all these businesses that have these supply problems. You hear about the Fed. They're not using the word transitory so much anymore, but when we think about supply problems in your specific businesses, so just this little snapshot, you feel the supply problems are transitory in nature. For example, lumber prices went through the roof and now they're back down.
Right.
And we're seeing that in various sectors. And just what's going on with your industries?
I think for sure, if the specific question of will the commodities normalize and are we just at a peak of a cycle, will they come down? Yeah, of course, but I just can't, I'm not in the business of trying to figure out when that's going to happen. I fix troubled businesses, and the number one rule for making more money is first contribution margin, second overhead, and then last top line, right? That's the way that we go about it. So I look at my contribution margin, not a gross margin, which has got a bunch of crap loaded into it, but just selling price minus variable cost. And you have to flow it through. If you're going to make more money, particularly in manufacturing, you got to focus on that. And so if you can't bring your costs down, you have to bring your price up. That's just the daily thing about it from my perspective. And so, and what are your variable costs? Well, the supply chain is part of that, your direct materials, but also your direct labor, which I already just confessed I've jacked up considerably, just trying to hire people, right? And then there's a productivity efficiency part of that, but that's never material enough to help you out today. So it's a big issue, and will it normalize? Sure, but we need to survive in the meantime.
Just to pile on that, just to go off of it a little bit, but to me, it's the labor side is going to be the difficult piece, and I think it was said before, because the reality is that labor side is going to continue to go up, and then something that kind of wavers off of the supply chain today, but I think as an overall effect is the whole climate issue. I mean, the reality is that as a bank, we're already starting to look at the climate impact of each of our clients, and we're going to be required by the OCC to do a deeper dive on that. And while that today doesn't mean anything, but it really does, right? The reality is that a couple of years from now, we're suddenly going to be saying, well, we're not going to do that deal because of its climate impact. And then you look at sort of the investment spectrum and what's happening with oil and gas prices, and that gets back to inflation, right? I mean, if oil and gas prices go like this because nobody wants to invest in them, and you've got banks making determinations of what they're going to finance because of climate impact, I mean, that can be very inflationary, I think. So just, segue it out of a few years. But.
Yeah.
Just to go back to something, Jonathan, you talked about the how well it's working on a remote basis. You see, and I'll talk to Scott about then the turnover in the professional firms that we're seeing. Do you see that turn to that we haven't figured out how to apply the glue of being together in a remote environment, and as a consequence, you're basically baking into your model a higher rate of turnover, which is a very costly thing. So although you gain on productivity, you actually may be a net loser because losing experience, recruiting costs, onboarding costs, retention costs to keep that group happy. If we go the route that people want to, do you really think that we're not giving up some of that glue that has made this group in this room work better together than, say, the group that next group does? I'm worried. I'm worried about that. Yeah. I mean, I'm in Toronto. I'm in a law firm. We're getting picked off by LA firms, New York firms, because they're hiring virtually, and that's great. So somebody's burnt out because they worked 12-hour days instead of 8-hour days because they they don't count the commute as their work day. They take a 30-minute lunch because they're not going out with a client. And so our productivity went right through the roof as a law firm, absolutely through the roof. Our production was up year over year.
But you've lost the connection.
But we totally lost the connection.
Exactly.
And our turnover rate has gone to shit.
So
and it is a like, guys, this is we're buying into a concept here that's not proven. We have not proven that we can actually retain people and get them properly engaged in a remote environment. And buying into this is a real serious risk to the competitiveness of our environment. You don't have that problem, Scott, at your plants. You've got a labor market problem that's probably determined by government subsidies that have made it more favorable to stay out and not work.
Government subsidies. I think it's a related. Sorry, that question was for you, and I'm jumping in.
It's all right.
I tell people that want to listen to me, yeah, there's government subsidies, and people would rather, particularly on the direct labor, non-professional side, people would rather just get their paycheck from the government, which is comparable. But even that's dwindling off. But David, you know this, maybe Aaron knows this as well, that when a long time ago, when I turned 40 and I sold all my businesses, I was going to take a year off, and I ended up taking 2 years off and just doing nothing. And just, it was a drill to get to Starbucks some days. And people said, well, it must have been really relaxing. I was like, yeah, it was relaxing. But the most interesting part wasn't that. Most interesting part, it was damn near impossible to go back to work after 2 years. It took me a year to put in a proper 8-hour workday. Just from a fatigue perspective, your body just de-stresses so much, never mind a 16-hour workday. And so what's gone on in the world? Well, we've been paying people to stay home for 2 years, and that gives you a lot of time to think. And I think it's hard to go back to work. I think you're just seeing that. And if you can't build the connection, because it's all virtual, if there's no mentoring, if there's no lunch, if there's no drinks afterwards, if there's none of the fun and the connection to the brand that you've built, why wouldn't they go to the next highest bidder?
So David, you come from a place that I relate to a lot on the law side. I was a Kirkland & Ellis lawyer back when Kirkland I was the 10th bankruptcy lawyer. There was almost, it was small, right? And this relates a lot in a law firm. In my world, your question's a great question. And our answer is we've not seen the problems on the attrition side, but it puts a much heavier burden on management, on active management of people. And in a lot of organizations, you don't focus on that. You do your work, you have people who do their work, you manage them doing their work, everyone goes home. In that environment, being together can be very helpful. We've got this summit I mentioned that's happening today and tomorrow, 40 people, 11 presentations, all virtual. People have received packages, prep work, a ton of effort went in on the management side. And you see lots of businesses now saying, look, if you're not gonna all come together, bring back the restructuring group, bring back the labor group by group, do things that are in person, do summits that are in person, do dinners, bring them together, because if you don't do that, you run the risk of day-to-day productivity with no bonding, no connection, no mentorship, and the result is attrition, which is bad. But I feel the question, and it's a great question. Sorry to monopolize that.
No, perfect. We're cutting into beach time now. So.
They want the cabana. We get it.
Well, I'm going to call, I let you guys go on because it was going so well. And that's exactly what we were looking for, is real insight. And I mean, what a year and a half, we'll never repeat. And who would have believed it? Mm-hmm. But I think we can tell this panel just is an example of why the live is so good, right? Because we've been doing all these Zoom panels and you're sitting in your living, and here is just much better interaction and with a live audience and stuff. So, and that's the whole point of this whole conference. So thank you, great panel. Thank you, everybody, for attending. Thank you, virtual out there, for if you sat through the whole thing. We really love you and we appreciate that. Send us feedback of how we can do this better. What was it like from your perspective? And thanks for everybody. We tried to create lively conversation and it really deal pros, that not people that just want to be professors, but really in it. And we're honored to have panels like this, and it was great. So for people here, we're going to, the cabanas open at 2:00. There's going to be drinks there of, I think, wine, champagne, waters. I'm not sure exactly. But, and then the big event tonight is we're going to, Aaron's Red Steakhouse, which I've been honored to be at. It's one of the nicest, best food in the country and great experience. So we'll have a shuttle that's going to make circle trips starting at 6 p.m. So thank you, everybody, for attending. Thank you all the panelists, our sponsors. If we can put them up for one last time. This couldn't have happened without them. It was an idea. And here we are, and we're all working together and getting to know each other, and going to do some great deals together in 2022. Thank you to the sponsors. Thank you, everybody who helped us. Thank you. Goodbye.